jobs number was a weak number. But, you do have to take that into consideration, that it's coming off several really strong numbers. We've been expecting a slowdown in the job market for a long time. We think it's tariff induced, but just as 320 was probably too high, 20 was probably too low. We look at it, the job as running at about 150 in an underlying pace right now.
It's tariff induced. It's not just that the labor force is now shrunken to the point where it's hard to get the type of worker that you want.
People have been complaining about inability to find laborers. We heard Powell talk about that last night since 2014, 2015, and yet we keep adding 2 million or so workers per year. I don't think it's the shrinking labor force that drove it. Drove this particular one.
How do you connect the dots? Which tariff initiatives are causing the slowdown in jobs?
Yeah, so we really trace it back to the tariffs on China, on Chinese imports into the United States. We've got tariffs on $250 billion worth of imports. We think that's had an outsized effect on manufacturing, and then that's kind of spread into the rest of the economy from
Even though manufacturing has been better than it's been in the last 40 years.
Manufacturing has been growing fantastically. We were on top of that story all last year. Just shocking strength in manufacturing. Lots of new manufacturing establishments coming online, yet a lot of those establishments were reliant on Chinese imports. And as a brand new startup, you simply don't have cash flow to pay 25%.
Right, Todd, we had a bad week in the stock market, which was different than January and February. But I noted that on Friday it had a chance to really get out of hand. It didn't. It was only down 20 points. And we're on the S&P, we're right at the level where a lot of analysts brought their numbers to after December. We're at right around 2750. And a lot of them are saying that's where we're going to end the year. Many have brought down the numbers. So, I mean, this just doesn't seem that horrific at this point. It could get bad, but at this point, where are you?
Yes, it isn't that bad, and we went up to that 2,800 level.
Again, and pulled back.
Yes, and we've, I think 4 times we hit that level last year, and pulled back at least 6% over a 2 to 3 week basis, at the worst 16% back in December. So you had some technical resistance up there. I think one difference, though, is back in 2018, the Fed was, every time we hit that resistance level, the Fed was either getting ready to raise rates again, or they just raised rates. Now we have a different sort of, the Fed is a lot more dovish, obviously, relative to last year. You just have to wonder if that dovishness eventually pushes the S&P through 2,800 and above the level that you were just talking about, where all these analysts think 2,750 is the level.
So what, were you coming into New York and you called us and said I'm going to be up there?
I said, hey,
honestly,
Joe, I'm going to.
You're from Schaeffer.
We're in Cincinnati.
From Cincinnati.
Ohio.
Why are you up here? You just and you're.
There's a Traders Expo.
Is that what it is?
Yes.
Have you been in this studio before?
I haven't been in this studio. I've been in the one in the NYSE, so it's been several years.
So, I mean, is it a shock to come to Andrews City here compared to Cincinnati? I mean, it's unbelievable. It's intimidating to us people from the Midwest, isn't it?
But the restaurants.
Restaurants. What about the traffic though, and like the airports? I mean,
you know what? I came in Saturday, Joe. Traffic was fine, and I actually thought there'd be more cars on the road this morning. It's so early.
I mean, you go to a sporting event in Cincinnati, you can park like near the it's just so much more livable.
Yeah, I need to get up to a Yankees or Mets game and see how that is.
All right. So, full year, where are you for GDP?
We're at 1.9%, and that's just because we
tariffs
think we're having.
Again? You hate those tariffs.
Yeah, I hate those tariffs. And look, it's the first quarter. First quarter, we're 0.4%. As soon as we get out of the first quarter, though, we're back to 2.5% growth quarter on quarter for the rest of the year. So it's just this soft
That brings
patch.
It down to 1.9.
That's right. Well, because, it's like in college. You get that 1D, pulls down the average forever.
Is that, I might have actually, but it was a pass-fail. I think it was a pass-fail. So no one saw it.
Hey, I flunked out of college the first time I went.
You got to get a C to get a pass on a
pass-fail,
you don't. I thought.
No way, not in molecular biochem or something. It's horrible. I mean, I got a physical biochem. I couldn't even tell you, I couldn't even remember the course. Anyway, that's not, you're going to hear a lot of criticism if it's only 1.9 after, spending $1 trillion on, on the tax cuts.
That's a fact. But, I think that criticism ebbs if we get that rebound in growth. And we're looking for a rebound in growth starting now. We think that the tariffs are a supply shock. Those effects are short-lived. Things pick up really quickly here going into summer. And so people will forgive a weak quarter if you're seeing 2.5%.
You think
What if they don't resolve, though, the China problems?
So if they don't resolve the China, it depends on what happens with the China. If they keep the tariffs at current levels, we're comfortable with our forecast. We're comfortable with that acceleration. Firms are adjusting
You
to
say
the tariffs.
acceleration, you're saying 1.9 for the year.
So acceleration from 0.4% growth in Q1 to 2.5% growth
Acceleration
in Q2.
during the year.
That's right, and starting now.
Does that lead to a possible flat 2020 or a negative year at some point? I mean, is there a recession on the horizon for you?
There's going to be a recession someday, but we
I know-
don't see it on the horizon. We're really enthusiastic
2020?
about the manufacturing. Nope, not in 2020, not in 2021. And the reason is that manufacturing rebound you were talking about. We see real productivity growth in the U.S. right now. That automation that was going to steal jobs is adding net manufacturing jobs to the U.S. as we speak.